Okay, good afternoon, everybody. Welcome to this outreach event hosted by the Dutch Accounting Standards Board together with the IASB and EFRAG. We will be discussing the exposure draft of the IASB that deals with general presentation and disclosures this afternoon. We've outlined about 3 hours for that discussion. My name is Peter Sampers. I'm chairman of the Dutch Accounting Standards Board, and I will do my best also to host this meeting and to take you through it. We have a number of highly respected speakers that are with us today. I will introduce them in a minute. But first of all, I would welcome everybody in the audience on behalf of the Dutch Accounting Standards Board. You may be wondering why this discussion takes place quite late in the, let's say, comment period, because the exposure draft is only open for comment until the 30th of this month. We had been hoping that after the summer we could have perhaps a blended physical meeting in Amsterdam with some people also joining by video or other means. But in the end, also the situation related to COVID is such that we had to decide to go for an online meeting. Welcome for that, but on the other hand also, we're sorry not to be able to host you in Amsterdam. But we think that certainly based on the experiences that also EFRAG had with similar meetings, this is a good way forward, and we should have ample opportunity for a good and insightful discussion. And let me upfront also thank EFRAG and the team at EFRAG for all the work that they've done in setting that up and preparing it. Now, perhaps we can go to the slides also, because on slide 2 I had a brief, on slide 3, a brief, let's say, statement on why we sit here today. Yes, that's already slide 3. Slide 2 was the introduction and the welcome, but I already went through that. But when thinking about this exposure draft and also about preparation for the event, it took me back quite a few years, because I did recall that in June 2013, it was Hans Hogevorst at the time speaking on the annual IASB conference in Amsterdam, announcing a 10-point plan to make disclosures less indiscriminate and more meaningful. I think that was a message that has been coming across to the IASB for quite some time now. Also at that time, there was a lot of discussion on information overload, on the ever-growing level of disclosures. And I think Hans's 10-point plan was a good step, at least, to think critically about what the relevant disclosures are and perhaps how to focus more on relevant disclosures instead of on all the, let's say, very extensive and sometimes also perhaps less easy to digest information that we have in financial and non-financial reporting. But it took some time for the IASB to work on the project. As by the way, not only this exposure draft, also important work has been done on, for instance, materiality. But for today, I hope that I suggest that we focus on the exposure draft that is open for comment. And how we do that, I can explain if we look at the program, which is on the next slide. And the program, well, I will not go to each individual item, but the setup is more or less that selected 4 topics that we want to discuss with, first of all, the IASB and EFRAG, and also with the members of the panel that will be supporting us in that discussion. We cannot have a live discussion with the audience, but you can raise questions to all participants in this meeting. We use Slido for that, and I will come back to that in a minute, also perhaps to help you get onto Slido. I will introduce the speakers later on, but what I would like also to do now is that is what I will do in a minute. And it is perhaps best also to go to Slido briefly so that everybody gets acquainted with the tool You can find it on www.slido.com. You've also seen the instructions, I think. And the code that you need to go to Slido is PFS for Primary Financial Statements dash DASB for Dutch Accounting Standards Board. And we have a first question, and I already see some answers, which is very fast. We have a first question on Slido that is just to help you get familiar with the tool, but also to find out a bit about your background. I see that projected now on my screen already. So I just need to make sure that I also get everything on my screen, which is the case now. So, well, we have a good mix of preparers and auditors at this moment, but it's only 13 members who replied as yet. And I see the number growing, and even and already a regulator joined also, I see. So please also answer the question 1, then at least you also know that you are on the system and that you can also raise questions that you may have. And feel free to do that. As I said earlier on, we do want to give you the floor and to be able to address questions that may arise. I see that we have a limited group as yet, but we will return to Slido a bit later also, just to see how you view a number of the topics that are being discussed and how you respond to those. Now, after those, let's say, initial moves, it is good that I briefly introduce the presenters and the moderator, and that is the next slide. So if we can move there, yes, thank you very much. Then you see the presenters that will be discussing the proposals. I start with Chiara del Prete. Chiara is the chairwoman of the technical expert group of EFRAG, and thereby also heavily involved in the advice and the comments that EFRAG has prepared on the exposure draft of the IASB. Ladies first, so I go to Aida Vatrenjak. She is with the IASB technical staff and has worked extensively also on the exposure draft and in the whole project. Hopefully no offense, Nick, but then Nick Anderson will be presenting the proposals of the IASB as a board member and also with a background in investing and analysis. He is, I would say, ideally positioned to help us through the proposals and to explain the proposals to us together with Aida. Filipe Alves is also one of the moderators and more on the background perhaps, but Filipe has been preparing a lot of the work as senior technical manager. He also was deeply involved in comments and the draft comment letter that EFRAG raised with respect to his exposure draft. I introduced myself, so I will not repeat that, save for the fact that I also have to disclose that I'm a board member of EFRAG. So in that sense, I'm also involved, at least in the work that EFRAG has done on this exposure draft. And in addition to that, as chairman of the Dutch Accounting Standards Board, we also have been preparing our own comment letter for the due process with the IASB. And I will share with you at least a number of observations that we will put in our comment letter when we are discussing the individual topics. So that was as far as the introduction is concerned. I will introduce the members of the panel a bit later when they are also going to actively participate. But I think this is the right moment in time, if it can be done technically, just to briefly revisit the Slido poll on who is in the meeting now. And then we go to Nick for to help us with the proposals of the IASB. And I note that at least a good turnout of preparers now, 55%, but only 33 members have as yet responded in Slido. We have at least more people who registered, but of course not everybody has to answer the questions. I see somebody coming in again. So Nick, with all that as let's say a kickoff, can I hand over to you to explain to us why the board came with this exposure draft and what, let's say, the principal considerations are before we go into the discussion on the individual topics.
So good afternoon, everyone. And first, let me thank the Dutch Accounting Standards Board and for putting this event on, this outreach event on. So this slide highlights what the board uses, and indeed the board's primary financial statements is in direct response to requests from users for improvements in performance reporting. I would say that every substantive proposal in the exposure draft, perhaps with one exception, reflect long-standing requests from users. And the next slide summarizes the board's response on different main areas. First of all, improving the structure and content of the statement of financial performance, which today we know varies considerably from one entity to another. Secondly, ensuring that investors get some information in the financial statements. And finally, ensuring that key performance are disclosed in a transparent and disciplined way. As highlighted on the next, we are still within the comment period. The comment period for our proposals ends on the 30th of September. You can find some more educational material on our website. We're pleased with initial feedback that we've had on our proposals, but clearly it's important for the board to weigh up costs and benefits. We're still very much in listening mode, and so we're grateful to all of you for your participation today. Thank you.
Okay, thank you for that, Nick. I would like to hand over to Chiara now, also to give her the opportunity to give some first observations on the and the initial position of EFRAG. Nick, we noted that your sound was not completely clear occasionally, so you have probably been informed about that. But also for the audience, we will look to improve that. Chiara.
Thank you. So good morning to everyone. It's a pleasure to be here, and I join Nick in a thank note to the Dutch Accounting Standard Board for having organized this event jointly with us. This is already the 6th or 7th joint outreach event. It was important to reach also your jurisdictions in our attempt to provide as complete as feedback as complete as possible. We have been following this project extensively in the last 2-3 years, and we have invested a lot. EFRAG has invested a lot in extensive discussion with all our working groups, and we are grateful also with the IASB with a fruitful cooperation to arrive to at this level of interaction in getting the European voices on this project. We issued our comment letter, as written in this slide, the 24th of February, so very early in the process, to allow the constituents to form their view also on what is relevant from a European point of view. And our comment period will close the 28th of September, so very soon. We expose in our draft comment letter, as usual, a preliminary and initial view, which is subject then to change after the comments that we have received through all these outreach process and the comment letters. During our discussion for a couple of important topics, we didn't feel ready to take a position because members were split. So for us, it's important to highlight a couple of points and supplementary questions that are also in our draft comment letter, and I will briefly explain this when we arrive to the relevant point of the presentation. Next slide, please. So we are very much supportive of what the IASB has done in terms of direction and objectives, and we are confident that the project will meet the objectives initially set up. But of course, when something new is introduced, and this is very much innovative and will contribute to a modernization of reporting, this is what we also think, the concepts are new and need to be tested in practice. So it's good to see that we have a good number of preparers today also to understand better what are your views.
Okay, thank you for that, Chiara. I think it was very helpful also for constituents that the EFRAG draft comment letter was out early in the process. That helps people to focus their minds. I think also as the Dutch Accounting Standards Board, we subscribe and support the objectives of the board. We have also been hearing users in our constituency who say that a piece of standardization and harmonization certainly would help to make the statements easier to digest and easier to work with. And enhancing consistency and comparability is certainly a good starting point there. We also agree, just as a starting point, that a new standard is probably the best way forward. You could alternatively also go to change existing standards, but that may perhaps not get the focus that you want, and also perhaps not result in a coherent and internally consistent solution. So in that sense, we support also the way forward of the IASB. What has to be noted and also acknowledged is that a lot of work has already been done, both by EFRAG and the IASB, also in field testing proposals, in getting and soliciting input from various stakeholders. This is also a further step to solicit that input, and hopefully also the topics that we're going to discuss and the debate on those topics will help us to distill some important messages on the standards and on the exposure draft. Having said that, as I said, we are going to discuss 4 topics. I will not ask the panel members as yet to give an overall view. I hope that they can retain that for a few more minutes, and then also perhaps bring their overall observations where we start to discuss the first topic. And Nick, the first topic will be then the classification of income and expenses and the presentation of those also on the face of the statements. So I return to you for an explanation of the proposals that the IASB has developed there.
Thank you, and please flag if there are continuing problems with hearing me, and we'll try and make some alternative arrangements, and Aida can certainly step in the meantime if needed. This slide, we look at about how subtotals are used today. We know that operating profit and EBITDA are very commonly used subtotals by IFRS preparers. And although these subtotals often share the same label, meaning can be very different one company to the next. We looked at a sample of companies, and we found 63 either an operating or EBITDA subtotal. But within that 63, there are at least 9 different definitions used. So we're proposing to introduce a more comparable structure in the statement of profit and loss. Define subtotals and categories in between those subtotals. And I'm being told the sound is still tricky, so I'm going to let Aida step in at the moment. We'll try and dial back into the call. Over to you.
Thank you so much, Nick, and good morning and good afternoon. It's a pleasure really to be here to discuss the proposals with you. And as Peter said, although a little late, we still have 2 weeks and we are still in the listening mode. So very much look forward to the feedback. So Nick has started discussing proposals relating to the categories in the statement of profit or loss, and explaining the need for the categories. As you can see on the slide here, there's lots of inconsistency in lack of comparability today that users tell us they sometimes are surprised about, because many companies use operating profit, and users sometimes in the meetings tell us, I'm so surprised. I thought this is already defined because I see it all over the place, but actually it's not defined and there's lots of inconsistencies. So maybe if we look at the next slide and we just look at what actually the proposals are saying. So this slide shows an illustration of what the proposals would look like applying the model, and the proposals are for what we describe a general corporate, so they look a little bit different for a bank or an insurer. We will come to that in a moment. And I just want to give you a warning because we find it's easy to illustrate proposals using an example, but this is just an illustrative example. So the line items that you see here wouldn't all be required line items, and companies would have different line items as well. What's important here to highlight is the new categories and the new subtotals which would be required. So we have 4 new categories here. You can see them in the boxes on the right hand side and the subtotals between those categories. So I will just briefly explain these, starting with operating profit. I already mentioned it's one of the most commonly used subtotal, very important for investors in analyzing companies' performance. And the objective that the board had in defining the operating profit is to ensure that it captures income and expense from what we say main business activities of companies are. So whilst it's meant to capture this, this is not all it includes, and it's actually defined as a default category. In other words, any income and expense that does not meet definition of other categories that you see below, and also that is not income taxes, discontinued operations, other comprehensive income which you find below and which are not affected by these proposals, or anything else would by default be operating. And this seemed a little bit controversial proposal maybe to some, but the board thought that it's better at achieving comparability of what gets classified in operating, and better information for investors. And you need to have some default category in order for things to add up, and it made sense for the board to have operating as that default because the main activities, the key activities of the business is the operating. But it was interesting, and Chiara will share that when we come to the feedback, that the feedback actually seems quite supportive of this approach in general. So I'll just briefly mention other categories now, maybe looking at the financing, which is self-explanatory in a way, that we have a profit before financing and income tax is subtotal before this category. The idea is to help investors compare performance regardless of a mix of debt and equity that different companies have. We had a bit of discussion here about some items included, things like interest on debt. Nobody would argue that it should be here for, general corporate, but other items classified here also include income on cash and cash equivalents, which is not shown in this example because it's assumed to be immaterial, but it would be here because proposal is that it's classified in this category because it's seen as a good proxy for excess cash that investors would consider together as a part of financing. And then we also have, you can see line item here, unwinding of discount on pensions and provisions. So this is what we say time value of money on the liabilities that are not from financing activities. And, we had a bit of discussion here. I don't think investors have unanimous view on this from what we have heard, but overall we heard that most of them do treat it as financing, and also pretty much all of them want a single location for this because currently, as we have seen in previous slide, they struggle with finding this. So that's financing category. And then we have investing category. The idea here is to separate returns from those assets that give rise to returns quite independently from entities' main business activities and other resources. So for general corporate, the things you would find here are returns on various financial instruments other than cash that we just talked about, and also maybe investment property returns and the like. And the reason it's separate categories that users tell us they analyze this separately from entities' operating profit, and they want to see this separate. And then you might wonder, what are the integral associate and JVs? Or maybe you don't wonder because we are so far down in outreach period, and you might have heard discussion about this. There's some controversy around this proposal. I'm just going to ask Filipe, I'm not quite sure if we have a slide specifically discussing this in slide pack. If not, maybe we just stay onto this and I'll just briefly explain. The proposal for integral associate and joint ventures came as a result of discussion of what to do with equity method accounting and share of profit or loss from these investments. And the feedback that we had, on one hand, investors said they don't want this in operating because it's not controlled by the company, it messes up their margin analysis. And on the other hand, companies say some of these investments are closely related to my main business and I want them as close to operating. So this proposal is seeking to balance these two needs to get this integral, so those that are closely related to main business activities close to operating, and then enable companies to present them together with the operating by this middle subtotal that you see here. But there's lots of, I would say, questions and perhaps some concerns around this proposal that I'm sure we will discuss in a moment. And I think I'm just going to briefly mention how proposals apply to the banks. If we have a slide on this, which I'm not sure that's... Yeah. Okay. So let's just briefly discuss, because previously I said it's a no-brainer to have interest on debt in the financing for general corporate, but similarly it is a no-brainer that interest on debt should not be outside operating for a bank. So the bank could not apply this general model and achieve useful operating profit classification. So what the board has proposed is principles that are based on what companies' main business activities are, and depending on those, and defined two main business activities as in provision of finance to customers and investments in the course of main business activities. And whenever a company has one or both of these main business activities as their single activity or as one of their multiple activities, then they would be required to move income and expenses from investing and or financing categories into the operating. And you can see in this illustration here, it's actually pretty similar to what, companies like banks report today in terms of classification. So expectation is that most of the income and expenses would be operating for them, but they would still be required to present associate and joint ventures in the same way as others, outside operating, split between integral and non-integral, and also keep the interest on pensions outside because the function of that is the same between all companies. So I think it's probably a good point for me to stop. And I'm sorry, Nick, you would have explained this much nicer, but I tried. And hand over to Chiara for EFRAG's feedback on this topic.
Thank you, Aida, for this introduction of the topic. And yes, indeed, operating profit or loss is a key element of innovation in this exposure draft. We ran an early stage analysis before completing our draft comment letter just to get the first ideas, and we also found that operating profit or loss was used by most of the listed entities. Almost all have a similar concept. Sometimes it's called operating profit, sometimes is called operating result, operating early, or underlying, or something like that. So there is a need to derive some added comparability, and we think the effort the DASB is doing to focus on this concept is crucial for the overall success of the new structure of the profit or loss. Of course, for the preparers, this will mean that whoever is using these acronyms or this label will have to check whether the content is still aligned with the new concept of the IASB. And similarly, those that use other names will have to decide what to do. And we still don't know, and we are trying to understand with the feedback whether this will result in more or less use of non-GAAP measures after the implementation. So as Aida was saying, we are very positive about this direction. However, when it comes to the allocation of the single items to these new 3 categories, this will be the effort of the first-time adoption for the preparers and also for the users to get familiar with this concept. When discussing whether we, as a group, we agreed with the proposals to allocate items to the various categories, there were 2 items where we understand the IASB took a conventional approach, which are the cash and cash equivalents and the time value of money, where the proposal is to include them in the financing category, but as a convention so that the users know, the reader knows where they can be found. But still, some of our members would have preferred a more principles approach, also to principle-based approach also to these 2 elements. So that's why we are seeking views on where to classify these two items. Next slide, please. One of the comments that we have in our letter is also that we observe that the labels of the 3 categories is not always aligned between the statement of profit or loss and the cash flow statement. So we are encouraging the IASB to consider again this element and either to change the spelling or in waiting to undertake a more broad project on cash on IAS 7 and cash flow statement. We are not suggesting to cover those changes in this proposal because we consider that it's urgent to finalize this as it is. We also have a concern around, or a remark, I would say, around how the proposal would work for conglomerates, where conglomerates are defined as those groups that have different lines of main business activity. So from an implementation or interpretation, first look at the proposal, we were struggling to understand how this clear division of items between the rows will fit into a structure of a group that has got different business lines, and how these would reconcile with the concepts of operating segments in IFRS 9. There is also an element of complexity when looking at these segments at the legal entity level, subsidiary within a group, and how then the same items would be reclassified in another line for the consolidated, because the level of judgment when you assess whether what is main business activity may be different in these two elements. We also had comments around the practicality of this definition of main business activity, which we agree is a good way of approaching things. So there is an element of residual, as Aida was saying, after having classified items in other categories, then we are left with everything else, which is operating. But we also understand that currently this everything else also includes other concepts, like, for example, entities may use concepts like core or non-core divisions or discontinuing operations or something like this. Well, everything will be included by definition in operating profit. So this may create an element of innovation also. We also noted that we agree with the financial institutions approach, so the fact that financing is a core element of the business activities there. We had some reservation on the option for entities that, such as the manufacturer, that provide financing to customers, where there is an option to classify in the financing components in the operating category, and we think this is relevant only when providing financing is the dominating business activity. And I think I will stop here.
Okay. Thank you very much, Chiara, for that comment. I will also briefly give some of the highlights of the Dutch Accounting Standards Board views, but before doing that, also for the convenience of the audience, I would like to point out that the slides that are being used are also available on the EFRAG website. So in case you find it handy to have them, you can find them there. As I said, some initial views also of the Dutch Accounting Standards Board. We certainly support let's say, a clear definition of operating profit. We do observe that it strongly hinges now on also what the concept of main business activities is and how clearly that can be defined. So that's at least something where we also ask perhaps for some further guidance or some further clarification. And in that clarification, perhaps it also would be useful to either make clear that it is not connected to the concept of ordinary activities that we know from the past, or that it is connected. So far, we see a bit of unclarity arising there. What will probably cause some, at least, question marks initially is that the definitions of operating, financing, and investing in the performance statement are not identical to those that are used in the cash flow statement. I think that is presently difficult to overcome. Well, for the longer term, we have also on other occasions been recommending the IASB to take on board a project on the cash flow statement. But, okay, that's not a short-term issue to address. So probably for the short term, it is important to make clear and also communicate clearly that those concepts are not completely identical. And just also to already cover one question that was raised by Chiara, we find it at least appropriate that the income on cash and cash equivalents is seen as part of financial income and expense, because usually companies, in our view, manage that as part of net debt, and that includes also cash and cash equivalents. So that were some first initial reactions. But more importantly than those initial views of the Dutch Accounting Standards Board is, of course, also how do people dealing with these subjects review the proposals, how do users look upon the proposals, and how do preparers also, who have to make the proposals happen to some extent, look upon those proposals. We invited a number of panelists to discuss these topics. And if we can return to slide 7, then I would like to briefly also explain who is on the panel. But I don't see slide 7 yet, so I give the Secretariat another moment at least to get it on. Yes, there we are. I will not start with the first one that I see now, but I'll start with Laurine Lemont. Laurine is working at DSM in the Netherlands as Director Accounting Policies and IFRS. So Laurine, very welcome to be in the panel, and we look forward to hearing your views. And of course, she comes with a preparer background. So let me bridge that logically by going to Ernesto Escarabajal Baadenhuijsen. If there is a simpler name, then we leave it at Ernesto. But Ernesto is also very well acquainted with the proposals. He's responsible for accounting policies at Shell. And I know that also he has been looking into the proposals in depth in the past. From the perspective of the users, we have Martijn Bos and Dennis Jullens, both on the call. Martijn is working for Eumedion presently, the body representing, let's say, large institutional investors in the Netherlands. He has a background also in investment analysis, and he worked as an analyst for quite a number of years at Robeco. And the other analyst background is Dennis. Dennis Jullens is now teaching at the University of Amsterdam, but he spent a considerable time in his career also analyzing both financial statements, but also accounting policies at UBS. So a very, let's say, capable and interesting panel, and I look forward to hearing your views. Now, whilst introducing the panel, I also introduce Gerard van Zanten. although Gerard's role is slightly different. Gerard is a partner at EY and responsible for IFRS, amongst other things, in the Dutch office, but also internationally. Gerard has agreed to, let's say, observe and to also do a short wrap-up at the end of the meeting, taking or summarizing for us his major takeaways. And that is in that sense also useful because Gerard is also an observer with the Dutch Accounting Standards Board, so he's also quite familiar with views, maybe the result of these discussions for those initial views. So all very much welcome. And Gerard, if you feel obliged or feel the need to raise your voice already also in the panel discussion, don't feel shy. You're also welcome to contribute there, but we can also respect if you want to focus on summarizing and wrapping up later on. Now, after all that introduction, and after having heard both the proposals of the IASB and the comments that were raised on those proposals as far as the presentation is concerned, maybe, Martijn, I can ask you to kick off, let's say, the debate. This has all been done to help users' needs. So hopefully you can either say this is helpful. If you say it is not, then also that would be an interesting observation. But your views, please.
Well, thank you so much, Peter. This is definitely a very favorable project for investors, and it's part of better communication, and definitely this contributes to better communication. As indicated in the introduction, that investors, many investors assume that operating profit is defined by the IASB, and for many a surprise that it isn't. And we not only agree with that there now is an operating defined, the way it is defined using the residual approach adds to a solid basis to interpret what companies report on. And obviously there's a lot of diversity in practice, and I also heard EFRAG's fear that maybe there will be more management performance measures resulting out of this. We don't really see that as a problem. MPMs are not bad. They add to the understanding of investors as well. So the really good thing about the way the IASB is now proposing to define operating profit is that we can truly judge ourselves whether we agree with the changes that management make to their version of operating profit, because a reconciliation will be required. And this will make the life of analysts an awful lot easier. And this is just one of the many great elements of the proposals. I just want to highlight aggregation, disaggregation, and Peter, I just don't know how much time I have. I can make a whole
interrupt you if it's too long.
Okay, please indicate so. Aggregation, disaggregation is also a real solution for what analysts experience as a discomfort in analyzing, that there often items added together where their nature doesn't really, it would be more insightful if they were not aggregated. And
we will return to that also in topic 3. Yeah? So okay. Maybe that, yeah.
Shall we pause for a second?
Yeah, okay. If you pause for a second, and perhaps also either Laurine or Ernesto can give us a first take. How do preparers view this?
Yeah, Ernesto speaking from Shell. I think this is the part that we like most of the proposal. Seems almost to be the low-hanging fruit. As from the preparer's view, it creates consistency between companies, so it makes things comparable. That's a good thing, because in the end we are trying to provide relevant information. In terms of the effort, I'm not so worried there. What we see in doing field testing on this, it is relatively simple to make the reclassifications, so not too much concern there either. So with relatively low investments, we can get a good result in terms of harmonization. A few items where we have some doubts. For example, the accretion on provisions. We keep, for example, large provisions for decommissioning and restoration, which may happen in only 20 or 30 years' time. It's not a real liability. We're not being financed by anyone. So the question is whether financing is really the appropriate category there. It was mentioned also cash, interest on cash to come into the financing category. Well, usually it's not material, specifically with the low interest rates nowadays. So we're not too worried there, but the question is whether it's really consistent. But in the end, I think it's a good proposal. It really strengthens harmonization. In terms of MPMs or APMs, from our perspective, I don't expect any additional APMs to follow from this. Okay. Back to you, Peter.
Yeah, thank you, Ernesto. And perhaps to continue then, Laurine, do you share those views, or is DSM's position different?
Yeah, that would be interesting to hear. We had a completely opposite view, but if we go to the first topic, Peter, if the split in the P&L, how it's presented, I think for us it was not a huge change compared to our current practice. So there are some refinements here and there, but generally we saw it as more as a natural thing to do. Making these definitions are also not groundbreaking or earth-shocking to us. So we already applied many of the concepts that are in the current proposal. Also, I'm not afraid of extra MPMs or additional measures. It is still, EBITDA is still not in, but that's fine. In our industry, this is used, and that will continue to be used. But I don't see it as a problem. We can perfectly handle the challenges that are there on the reporting area with the current standard. So it provides a bit more clarity, and I always welcome that. Although I'm always also in favor of having some room for interpretation. So guidance is good, but some interpretation is always good.
Well, certainly if we come to the next subject, then there will be room for interpretation if we discuss the associates and joint ventures. But let's not go there yet, because Dennis may, of course, now completely come with a different view or acknowledge also what he's heard from others. Dennis, how do you look upon the proposals?
We're all cheerleading the proposal, aren't we? Now, before, might I have kind of 90 seconds to explain how analysts and investors will look at valuing particularly non-financial firms and why the proposals are so helpful. If we are valuing non-financial firms, we're going to analyze historical operating profit, forecast operating profit, using a model to translate that forecast of operating profit into an assessment of the value of the business. And then we're going to deduct financing liabilities, and we're going to add the value of investments. Now, the proposal helps us a long way in classifying the operating, the investing, and the financing items. So that will help us in terms of the presentation of the income statement. Now, clearly, this will need to be eventually aligned with what happens in the balance sheet, but that's going to be a long project in the making. But in terms of the presentation, we have operating, investing, financing. The proposal also resolves some issues regarding the income from associates and joint ventures, but we're going to touch upon that in a moment. I hear Ernesto. I have sympathy for the treatment of the interest on financing type liabilities as well as on the interest in cash as a financing item. To give you an example, investors and analysts will generally treat a pension deficit as a financing liability. Therefore, it would make sense to present the interest accretion on the pension liability within the financing item as you would the interest income on the pension assets. So overall, positive. Clearly some details which we're going to dive into in a moment. Thank you.
Dennis, thank you all panel members. So in a nutshell, I think there was quite some support for the proposals that are being raised by the IASB. But of course, we're discussing that in the small group, you could say. We also may invite the audience to tell us what their views are. So we have a polling question dealing with these proposals. That's question 2. And I would invite the members in the audience to go to Slido and also answer question 2. Now, it might be helpful also to get it on the screen for those who are not yet on Slido. And there you are. So the question is, do you think that the new required allocation of items in the subtotals will result in better information? Yes is an obvious answer. No, as it will impose uniformity and reduce the space for entity-specific allocations is, let's say, the counter-argument. And don't know would be then the third possible answer. Although it is still a limited number of participants, I would say we see a large support also for the proposals here, with 90% saying yes, it will improve. It will improve, let's say, the information, and thereby also provide better and more consistent insight. And also when more participants join the voting, that doesn't really seem to change. It even takes it higher than 93%. So in that sense also there appears to be quite solid support for these proposals as they have been raised by the IASB. Now perhaps Nick or Aida or Chiara, does this give you any further pause for thought or new insights, or is this largely in line also with what you have been hearing so far? And I know it's always difficult to ask two people to comment, so Nick, if your line is better, perhaps you may try. If that is not the case, we go to Aida. I leave it up to you.
Peter, sorry to interrupt. Could we just remind participants, the audience, that they also can put questions into Slido and that we can answer those questions in the meeting?
Yeah. Thank you for that reminder, Filipe. It is indeed good, and that also leads me to conclude that you haven't received questions so far. And indeed, we are inviting questions, so those who have them, feel free to raise them. Also on other subjects that come later or that you've seen in the exposition. Nick, any views from your side that you want to share based on the discussion so far?
Yes, thank you. So very pleased to see those results. That's very reassuring. I'd say this has been very well received by users in having a consistent operating profit. Even those who didn't realize we didn't have one beforehand are pleased we are going to have one. I'd say there's a mixed response from corporates. I'm very pleased with what we heard from Royal Dutch Shell and from DSM today. Some feel that they really want to retain the ability, as they describe, to tell their own story and to use metrics that does that best. And I guess our response to that is the potential to use management performance measures to do that if required. But I say these proposals have generally been well received.
Okay, thank you for that. And well, that's good then that you've come with proposals that do get good support. Chiara, any observations from your parts?
I see that in other jurisdictions we observed a majority of support, but here we observe a clear, almost unanimity supporting the proposals. And considering that I understand the majority of the participants are preparers, this is a good sign of acceptance of the proposals. Coming to the comments by the panelists, it was interesting to hear this nuance in interpretation of what is financing and why the long-term decommissioning liability may be seen as financial by the users, because here we may see a slight different sensibility between users and preparers.
Okay. Thank you. And then indeed, that is interesting also to have that observation. I don't know whether any of the panelists requires a second term to give some views or to say something else on the proposal, or that we have questions from the audience, which Filipe would be able to tell me. But if it remains.
At this stage, we have not received questions from the audience, so I would invite the audience to go to Slido and then click on Q&A and put your questions about the classification of income and expenses into the different categories.
Okay. Thank you for that. And then I also think that we come at a logical point to move to the second topic that we want to discuss. And that second topic deals with associates and joint ventures, and especially also the distinction between those who are integral or non-integral. Now, Aida already gave a short introduction whilst discussing, let's say, the setup of the income statement, but I think it is worthwhile for everybody in the audience just to briefly also, again, say what the IASB intended and where the distinguishing features are. I don't know. I think Aida, will you take that up?
I'm going to pick up. I'm going to pick up on that. So, as you say, we've discussed this briefly, but just to reiterate. So, what we find is that investors often value associates and joint ventures separately from the company's main operations. And that's because these investments aren't controlled fully by the entity, and as we know, they're accounted for using the equity method. So a key message of feedback from investors is that they do not want to see a share of profit or loss from associates and joint ventures in operating profit. At the same time, companies have told us the way that business is changing is that often joint ventures in particular, and sometimes associates, can be important to their operations. They can be integral to those operations. And that in that respect, they'd like to see them in operating profits. So the board heard some conflicting, perhaps mixed messages, and sought then to see how to resolve that conflict. And this took us to the rationale distinguishing between integral and non-integral associates and joint ventures. So, as I said, the share of profit and loss from all associates and joint ventures is excluded from operating profit. The non-integral associates and joint ventures are presented in the investing section. And companies would have the opportunity then to present their integral associates and joint ventures slightly more prominently above the investing section with an additional subtotal that would sit closer to operating profit. Now, I would say that we've heard some mixed response from both users and preparers in respect of these proposals. They certainly require judgment, as you highlighted, and we provide some indicators to try and help with that judgment. But we're interested to hear more feedback today and any ideas in terms of how to proceed from here. Thank you.
Okay. Thank you, Nick. And then I think, Chiara, you also heard already some concerns.
Yes, sure. We, in our early stage analysis, we also found out that there is diversity in practice in the classification of the results from investments classified equity method in the on the face of financial statements. So for sure there was a need to set up a new proposal to remediate to this diversity in practice. However, in this case, judgment is involved in in defining when an investment is integral and when it's non-integral. And therefore, our questions in the comment letter related to the need to expand the indicators that are provided, for example, now in paragraph 20D of IFRS 12 on how to make this distinction between integral and non-integral. In particular, also during the initial interactions that we had in the previous discussions with in other jurisdictions and in the field test, it seems to be a little bit of interaction between the definition of main business activity, which will lead to the identification of what is in the operating profit, and the definition of integral. In particular, there were instances where the management sees an investment as being part of the core business activity and crucial for the success, but due to peculiar reasons and business model approach, there is no real integration of operations. So this is an example that demonstrates that perhaps something more needs to be done in terms of consideration of the definition. We also have a question on usefulness of a possible disclosure of income tax related to associates and joint venture. Now, the fact of having the results of integral investments is good within the operating, but is also mixing an item which is net of tax with an item which is gross of tax. So question was whether it would be A, feasible for the preparers, and B, useful and needed for the users to also disclose these element. Not sure I have a second slide on this point. No, okay. So I would say yes. We confirm that it's judgmental because it's new.
Yeah. No, thank you for that, Chiara. And I think also in our initial response, we confirmed that it is judgmental what is integral and what is not integral. Whether that is bad or good, you may think about that in our view, because the judgment that management makes also probably is informative for investors, because it shows how management actually sees its own investment in those companies. And as a personal sidestep, I recall working for a company in the past where on the one hand there were joint ventures that were producing essential components for the finished products, where you would arguably say strategically that is very integrated, where other joint ventures in activities where actually a spin-off was being prepared and the company wanted to step down its investment gradually, in fact, bring its investment back to zero, where the integral nature is clearly not there. So I think that judgment in the end is certainly to be made, but could also be informative. And we even think that the current definition of integral associate, saying they do not generate a return individually and largely independently of other assets, may be too restrictive in some ways, where that really ring-fences choices that management could possibly make. And in our comment letter, we will also refer to some examples in real estate, where probably we think it might even go wrong, but I will not dwell on that for the time being. That's perhaps too detailed. Investors, on the one hand, to get a better understanding. That's also for us perhaps a bit of an open question, but we have people who can help us on that. And whether it is doable for preparers and which challenges they see, that's also an interesting question. And maybe that we can start with the last one. Now, Ernesto, Shell certainly has quite a number of associates and joint ventures. So no doubt you have thought through this and have a view on this.
Yeah, Peter, thank you. Indeed, we operate a lot together with partners in exploring new oil and gas fields, for example. That may be in a joint operation, or that may be in a joint venture. Also in LNG, we see that. So it's really a major component of the business that we do, and it is very relevant. I find the split an interesting one between integral and non-integral. On one hand, you don't want your business to be sitting in the investing category, but more in the operating category. On the other hand, we have joint ventures and associates that are clearly from an investing nature, and those should not be in operating. So I like the concept, but at the same time, if we look at how the standard or the proposals have been written, it works for most of our general business in downstream, for example, where we sell fuels under our own brand name. But it does not work at all in our upstream business. When we looked at our joint ventures in the upstream business, we see that a lot of these do not classify as integral to our business, whilst we manage them in a very different way. Whilst our internal reporting is done in a very different way, whilst they are in exactly the same industry, whilst we may even have operatorship, we deal day to day with the operations, etc. So, from that perspective, it is clearly integral for us. But if you look at the requirements how they are written now, they would not classify as integral, but as non-integral, meaning that we get a completely wrong classification. So we'll certainly comment on it in our comment letter. But I have very much concerns that we will end up with wrong classifications, not giving a better insight in what business we are actually doing. So then there's another thing to note in terms of the cash flow statement. The dividends from integral joint ventures will be in investing, which seems to be a little bit inconsistent with the fact that integral joint ventures and associates are more of an operating nature. In terms of how much work is it? Yes, it is a lot of work to identify all the joint ventures, all the associates. It is doable. But it is a lot of work. But if it provides better information, which is useful to the users, then of course that work can be done. But very much a concern on the definitions of how to distinguish integral and non-integral at this moment in time in the proposals.
Perhaps a follow-up question, Ernesto, then. Would it help you if the definitions were less strict and there was even more reliance on management view in this matter?
Yeah, I certainly would think that would help. More on principle based, looking at other factors as well. Like I mentioned, how does management review the information? Are we simply sitting there waiting for the dividend, or are we actually involved in the operations? How do we report it? These kind of things. What industry is it in? So that would certainly help. All kinds of criteria that would help you to make an assessment based on the substance and not so much rule based.
Okay, thank you for that initial response, Martijn. I also have the feeling that you would like to share your view.
Yes, thank you, Peter. First of all, I think I'd like to stress that the proposal of IASB to exclude the results from joint ventures, any joint ventures and associates from operating profit is a sound one. So that's really the paramount for investors, because we want to relate operating profit to revenues. And the revenues of a joint venture and an associate are not included in revenues consolidated. So this is a paramount one. Now, the subsequent question, well, do we need a subtotal, as discussed, for integral associates? And I would argue we would not need such a subtotal. in the face of the primary financial statements. I mean, it's quite a prominent place. I think the reality for many companies will be very different, and probably a binary distinction between integral and non-integral is in reality, we have not observed this in the past decades, and suddenly it seems to be popping up, and I expect it to be more of an accounting gimmick than truly. I've not seen companies reverting to this presentation in primary financial statements, or if so, it is probably rare. I think this can easily be handled through better disclosures in the notes, or possibly an NPM. So I don't see the need for this, and I would not. The thing is, if you introduce the term, you actually request all companies to gauge whether which of our joint ventures are integral and which are not. I don't expect investors to use this distinction between the two. Thank you.
That is at least a very clear position. So that's providing transparency, I would say. Dennis, would you subscribe to that, or do you hold a different view?
I would first of all agree with Martijn that it's good that these income from associates and joint ventures are now presented outside of operating profit. Perhaps somewhat surprisingly, I also agree with him on the second point. I believe that analysts and investors will not make a distinction in how they approach the valuation of investment in associates and joint ventures, whether they are integral to the business or whether they are not integral to the business. As I tried to explain earlier, if analysts and investors look at the business, they value the enterprise, the operations of the firm, will then add the value of the investments, which will include the investments in associates and joint ventures. And I think having a separate presentation of integral, non-integral will not change that approach to valuation. So, and I agree, it might be another way to explain the relevance of an investment in associates and joint ventures for the operation of the business, rather than having this mandatory presentation on the face of the income statement.
Okay, so what I take away is the two key messages. At least it should dilute operating income, and on the other hand, transparency can probably be achieved by other means than raising it on the face of the income statement. Laurine, you've also been at least thinking about the proposals. How would it work for the, or how would you view the proposals more in general?
Yeah, of course, because during the field test, of course, we also tried to apply the full exposure draft and also had to make this split. I say for DSM, having these results separately disclosed is not a problem because we already did that. So that's not a big change. Therefore, also the investors would want to, they already wanted to know that. So we already disclosed it. So then we got to the point, okay, now we have to make a split between integral and non-integral. And it's very interesting to hear the views of the previous panel members, because we were also getting into these considerations, saying, okay, what should we use as a split? Should we, if we consider something as non-integral, would be actually admitting that you have invested money into something that's not supporting your business? At least that's how it felt. And I think investors would be critical to those type of investments for our company, because it's very industry related, of course. So that would make it, the kind of disclosing maybe even more, because in the discussions about it, we also said, if we consider an associate as non-integral, would that also be like a portal to held for sale? Because, what would the implication be for people working in that joint venture or that associate? So it says much more than a simple line in the profit and loss would say. So we encountered these issues, and of course we can make a split, and we can also apply the concepts that are here. But I think we have to think about, even when users say, well, this is not really additional information for us, okay, then take that also into account, because we never had a request to do this kind of split. So I think there's not really a need for it. And when the time comes, when something is really non-integral, then you have to communicate about it anyway. So yeah, it's a bit of a mixed picture. Applying something which you're asked to do, of course, you can make ends meet and do it. We don't have a large list of, so we can do that. But we can also already see our auditor checking our positions, why we would consider something integral and non-integral, and get into huge discussions. So yeah, it's a bit of a, I think, can it be applied? Yes. Would it help? Would it make it better? I doubt that a bit. So, but it's not very different opinion than the other panel members, I think.
Okay, so at least we hear a number of, let's say, critical thoughts on the subject, and that may be a good introduction then also to go to asking what the audience thinks. The audience has been listening into this debate. We have a polling question, which is question 3. It actually deals with the distinction. So I would invite members of the audience indeed to look into question 3 and to give us their views on whether this split is beneficial or not. In the meantime, while the audience is formulating its views, I can also ask Filipe whether we have other questions from the audience, which I haven't seen. But Filipe, is there something that we should raise, or?
At this stage, we still don't have questions. I'm just seeing that we have the polling and people are voting, but no questions. So I would invite the audience to include your questions to the board members or to EFRAG or even the speakers if you have any questions about the IASB proposals.
Yeah. And judging by the first, let's say, reactions, at least those look fundamentally different from what we saw in the polling question with respect to the, let's say, breakdown of the performance statement, because here we are not at 90%, far away even. Nearly 50% say it doesn't make much sense to break the split, and all should be presented in investing. There is nearly a quarter that supports the IASB proposals. And there are some, but still not a small portion, 20% nearly, that say it should be presented in operating. Well, clearly that is not at least meeting the desires of the users, as we've just heard. But all in all, but I think also Nick already said so in his introduction, this is not as clear-cut and not as widely supported as topic 1. Nick, any further reflections, or Nick or Aida, from the board on this outcome or on the discussion that you just heard in the panel? No reflection. Maybe Nick is on mute, otherwise.
Maybe we can't hear Nick. I will maybe just say a few words, and Nick, if you hear us and if you want to jump in, please do. And not surprised with the feedback. We are hearing this because it's quite consistent with the feedback we've been getting throughout the outreach. And it's interesting, this project is very much driven by investor demand, but this was one of the proposals which wasn't particularly driven by investor demand, but rather these, the differing views between preparers and investors. And it really shows in the feedback received, what Martijn and Dennis said is very consistent. Investors, I would say, are at best lukewarm. I've heard maybe a couple in the hundreds of meetings we have had that said they might use this information, but lots of them said they just they just worried about usefulness. And I think especially Ernesto's points and around the classification perhaps not working as intended. And I've noted down your suggestions about maybe additional indicators, but I do wonder whether even with additional indicators to get the outcome you want, whether it's feasible to achieve the outcome, and especially is it worth doing if all investors are telling us not really. So it's going to be really tough. I think it's something that we have to, as a team, when we go back to the board, present and present all these factors for the board to decide whether even to proceed with this or and how we can fix it, or is it time to shelve this perhaps? I don't know.
Yeah. Okay. Thank you for that. I noticed that Dennis has a question for the IASB. So Dennis, feel free to raise that.
Thank you, Peter. Now, it's basically a question for the IASB inspired by the observations by Ernesto and Laurine that there appears to be, so I'm paraphrasing, there appears to be some sensitivity among corporates about where these investments in associates and joint ventures are classified as either operating or investing. Is that a sentiment that you have heard before, that companies are kind of sensitive where it is going to be put?
It's Nick here. I think yes, and I think that was really the heart of the proposal, to differentiate between integral and non-integral, to try and allow companies to express that some of their joint ventures and operations are more closely related to operations rather than investments. So I think that was recognition of that. We had some very strong views, and we know today that some entities do include it in operating profit and others take a different view. But as Ida said, we've had fairly clear feedback that differential between integral and non-integral isn't particularly welcome, and has been received lukewarm. So I'm not really sure where we go from here, other than certainly perhaps putting simply associates and joint ventures together in one place, and then we'll have to think about where to position them in the P&L statement. But against that, what we've heard consistently from users is the same message that you made and Martijn made: please, not within operating at any cost.
Now, the reason for, sorry, Peter, but the reason for making this point, I'm less convinced, but Martijn might disagree. I'm less convinced that the users would, as they will treat investment in associates and ventures in a particular way in their valuation, I think they will be less concerned whether they are going to be viewed as operating or investing. But that might be just my view.
Yeah, Dennis, we have heard these points, and from some of investors as well, because they said, I would wonder what business do you have investing in this non-integral thing. So it has come up, and certainly, like Laurine said, I think many companies also identify this as a almost like political consequence of classification that is not just for investors but also for parties involved. I think it's a point also that's relevant to this discussion.
Perhaps another question in the same vein is: are there actually existing examples where companies use this distinction, or was it really dreamt up on a whiteboard thinking about the issue? Nick, feel free.
I've seen examples of this, of a European company certainly doing this.
Okay. Yeah.
So I could say it wasn't dreamt up on a whiteboard. That didn't drive us. The underlying, we're trying to look at a solution from what we're hearing from companies increasingly, whether it's a automotive manufacturer operating in China, where up until recently you couldn't own more than 50%, or perhaps whether it's in research sharing in the pharmaceutical industry, to reflect that some things were closer. But if it's not helping either preparers or users, and I think that's the overwhelming message that we're getting, we will have to think again, clearly.
Yeah. Okay. Academics would say there is anecdotal evidence that it is used, but well, we'll leave it to you wisdom to digest all this information. Yeah, perhaps some additional information from you, or
yes, now we have a lot of questions on the Q&A.
Okay.
So I think an
Filipe,
interesting...
yeah, go ahead then, Filipe. Just.
An interesting question is, do you expect to publish also an example for insurance companies like you did for, especially thinking on IFRS 17? I was wondering whether anyone would like to comment, or Aida or Nick, in terms of the...
Yeah, thanks, Philip. So I will just mention briefly that the exposure draft has a little booklet with a number of illustrative examples, and one of those examples is example of insurer. How could proposals apply? I mean, I just want to, maybe it's worth to highlighting all of these examples are not templates in any way. I gave this warning also when we were talking about subtotals using illustrations. So this is by no means insurer shall present like this or bank shall present like that. It's just an illustration of what proposals could like. And, you know, it's really beneficial for us that we are doing the field work in cooperation with EFRAG and with other standard setters where we have actual, you know, real companies applying these proposals, some of whom are with us today are there in the audience, and I can see some of them asking questions as well. So that will also inform and maybe help us improve on those examples as we finalize the standard. But they are examples. This wouldn't be mandatory presentation in any way.
Okay. Thank you for that. Any other questions, Filipe, that you want to share with us now?
Yes. So another question is, when splitting in categories like operating, investing, and finance, will this also apply to the effects of foreign currency exchange results?
That takes us back to topic one. But Aida, perhaps?
Yeah, I was just waiting to see if Nick was going to react to this one. It's just something we discussed actually just yesterday. I mean, yes, so all income and expenses that are in P&L above income taxes above discontinued are affected. So Forex, it applies also to Forex, and the proposal in the exposure draft is that entities shall classify foreign exchange differences recognized in profit or loss two categories depending on the items that they relate to. So if they relate to operating, they would be in operating. If they relate to loans, for example, they would be in the financing. But it's an interesting question because this is one of the proposals where we had some pushback from companies and that it actually could be quite costly to apply in a way similar to what I think we will discuss shortly with analysis of expenses by nature, by function. So we heard of some issues there. So this will be one of those topics that may be worth thinking about further. And maybe I want to use this opportunity and ask, you know, I don't know, on the spot, Laurine or Ernesto, whether you have any thoughts around Forex that you can share with us.
Yeah, Ernesto speaking. I see no concerns there. That's basically what we are doing already, making that split. So it's not really a really new thing, and I do think it makes sense to attach it to the categories where it belongs.
Yeah, same here from DSM. So no big concerns.
Okay. Filipe, another question from the audience. Preferably relating to the joint ventures that we were just discussing. And
I was trying to go through some of the old questions, but I have here on the joint ventures and associates, which are involved in potentially strategic technology, but having no link with today's operations. Would be these kind of associates joint ventures be considered integral? So
I can answer under the current. They wouldn't clearly meet the current definition or indicators that we have for integral, but we have heard that from a number of companies that, in some respects, that they would like the split between integral and non-integral to reflect management intent and strategic intent in that respect. So perhaps it may be an investment that they're making today with a view to taking full control, maybe an example we'll give in sometime in the future. Certainly, the entity talking about that would like to, reflect that as being integral rather than something that may be perceived as non-core. So that's certainly a comment we've heard.
Okay. Thank you for that, Nick. Filipe, also in view of the time, a final question for now, and you keep monitoring what comes in also for the third and fourth round, please.
On the associates and joint ventures, I'm still looking, but I think I've captured all the joint ventures. And so if all results from associates and joint ventures are investing, wouldn't you miss part of operations if ONG structures all upstream activities through JVs, example, risk sharing?
I think the short answer seems to be yes to that. I can't disagree with it as a statement. But I go back to the message that we hear. One observation is that we hear very mixed treatment of equity accounted associates and joint ventures today in the statement of financial performance, and a very clear message from the users of financial statements that they would like to have a operating profit number that was clean, free of any contribution from associates and joint ventures, to be consistent with the revenue line, I think, as Martijn highlighted.
Yeah, Nick, I think that is probably a very good sum up of what we have been hearing so far. Also being a bit cognizant of the time, I suggest that we move forward. But I do realize that I also at a certain stage asked Chiara whether she, after having heard all the debate, had some last elements to contribute on this. I do want to give her that chance if you have something to add or something to raise, Chiara.
Well, I think what we've heard today is very much consistent with the outcome of previous discussions. It was interesting to see the proposals perhaps to move to the disclosure this type of split and illustrating through the eyes of the management what approach has been taken in that respect. I mean, this has been an interesting possibility for the IASB to consider as a way forward. And for sure, also the element of, yes, having more indicators, but avoiding to go in a rule-based direction, because this is really the way management sees and operates the business. So there is a particular element of sensitivity there.
Okay. Yeah, thank you for that. Thank you all, also the audience, for raising the questions. So we get into a more and more, indeed, dialogue with each other, which is very good. Now, we noticed up front that the distinction between between integral and non-integral would be very judgmental. Whether we present cost by function or by nature, you could say that is not very, that is a binary decision. But still, there are proposals also on debt presentation and perhaps to make it more binary. But I don't want to preclude the presentations that we're going to get to hear from the IASB. And I think we're moving back to the presentation then also.
Thanks, Peter. I think that's cue for me to give a brief intro relating to the proposals that you just tee up, and analysis of operating expenses is one of the specific proposals from the group of proposals relating to disaggregation or improving disaggregation of information in the financial statements. And it's really arising from user feedback that sometimes the way information is grouped and ungrouped and presented does not give investors everything they need, which Martijn hinted on in his introductory remarks. So what this proposal is, so this is quite specific, and as you said, Peter, somewhat binary, although we will see not quite clear in some respects. So it's not a new thing. Yeah? So the IS1 already has a concept of analysis of expenses by nature or by function. So what these proposals are doing is what we call strengthening those requirements. And there is maybe 4 aspects I would like to highlight. The first is quite simple, is that this analysis would be required on face. You might not be aware, but actually the standard today gives companies option to provide this as a note disclosure rather than in the P&L. There are not many companies that apply, that do that, but still, you know, the ED makes it clear that this should always be on the face. Then the second aspect is that the ED makes it clear the company cannot simply choose which method it wants to use, but it has to be satisfied that it has the most useful method applied on the face. And to help companies decide that, the ED has a number of indicators to use, you know, such as industry practice for companies to decide the most useful method for their circumstances and use that method in analyzing operating expenses on the face. And then these are kind of, I wouldn't say less contentious, but we come into maybe more other 2 aspects that have received much more comments. The third one is companies shall not mix analysis of expenses by nature and by function. And what this means, so reminder, analysis by nature is when you show inputs used, so staff, depreciation, and the like. Analysis by function is when you allocate those inputs to activities in your company, such as cost of sales, research and development, and the like. And no mixing comes as a response to user comments or, you know, let's say complaints that they sometimes don't know if what's line items are complete. And I'm just going to illustrate this using one example. So in some industries, in some jurisdictions, it's common for companies to present both cost of sales and depreciation on the face. And what this presentation does is makes user unaware as to whether the cost of sales is complete. In other words, whether cost of sales includes depreciation that relates to the production of goods or services, or whether it is incomplete. In other words, depreciation is complete in that it includes all depreciation. They both can't be complete because then you would double count expenses, obviously. And this is really the main driver for the board's proposal to prohibit this mixing. There are some exceptions to this prohibition. That is, minimum line items that are already required in the standards would always need to be presented regardless of whether this is entity, whether this kind of breaches that nature function, because with minimum line items, it's clear they have to be complete, and those items are presented without any allocation to functions, for example. And then the final aspect of this proposal, and maybe the bit that we had most discussion about in the outreach, is for users have told us that regardless of the method that's most useful for company, they find analysis of expenses by nature useful in all circumstances because it helps them better forecast future cash flows. They say, for example, analysis of expenses by function is good for things like margin analysis, but for forecasting, it's easier to do when you have expenses by their nature. And driven by this feedback, the proposal is to require companies that present by function to provide analysis of their expenses by nature in the note. Again, this is not really completely new requirement. The standards already require this from today, but what happens in practice is that companies would tend to present a couple of items by nature, but they would not provide full analysis, so users usually wouldn't have information about, for example, raw materials, which they tell us is helpful for their forecasting. But as I'm sure we're about to hear, there has been quite a lot of feedback on this, and I think some of the feedback quite fair in that there are some things that I think need to be considered and fine-tuned in relation to these proposals. But I'm going to let Chiara tell us about all this feedback on the proposal.
Thank you, Aida. At the beginning, we expressed a sympathy without taking any strong position about this proposal, but we observed, as you also, Aida, were saying, that there is already an element of mix in reading the standard, the ED as it is, because there are minimum line items which cross between the two classifications, nature and functions, like the impairment or the cost of sales. So, but I would say that this observation, it's more about the clarification of how to intend the prohibition of a mixed presentation. So it's more the clarity of what the IASB intended to do. Where we are seeking views on the constituents is the real usefulness to have a disclosure by nature when the management has already concluded that the best or the most useful information for their specific case is by function. This is of course because this type of change in standard setting sees the two camps opposed. So for users, it would be good to have more disclosure. And we understand that in particular in Europe, the presentation by nature is considered the most informative for users. But from the other hand, whoever now adopt the by function approach will have to incur costs. And from the feedback we've got on the joint field test with the IASB, we understand that in some cases, depending on the complexity of the entity, this may be highly costly and imply also some IT functionalities to be developed. The second point where we are seeking views is whether a mixed presentation without any restriction would be the useful thing to do here, or a strict presentation either by nature or by function, so without the minimum line items, or as the IASB is now doing a choice between by nature and by function plus minimum line items. We wanted a bit of insight before we take a definitive position on this fact, on this proposal. What else can I tell you about the concerns? There were, of course, some implementation questions on where to classify some specific costs, like, for example, the restructuring expenses or the goodwill. It was not clear where to put them. And preparers also, some preparers that participated to the field test also would have preferred to have more flexibility to the management to explain better their performance. We've also heard that some users would have preferred a matrix approach, where you have all the items by lines and all of the items, by nature and by function altogether. Of course, this is not forbidden. It's always possible if the preparer considers that this is appropriate. But I mean, we agree with the IASB that didn't go that far because it would be really burdensome for the preparers.
Okay. Chiara, thank you for that. Yeah, certainly a matrix would solve all the issues except perhaps for the cost issue. So in that sense, also been discussing the proposals in the Dutch board. Let me summarize it by saying that certainly there is consensus that a clean analysis by nature, either on the face or in the notes, should be available somewhere, because we do see and also understand that information by nature maybe or is useful for investors and analysts. What you do then on the face of the statements, and whether that is by function or by nature, we have some members on the board also saying, well, there perhaps a mix, if that is also supported by the way that the business is managed and the way that management views the business, then a mix might still be beneficial and informative. that are not all members, but a number of them think like that. So in that sense, we're also still looking a bit for the magical bullet, you might say, that solves this dilemma. But at least transparency should be there, and probably also a clear-cut decision. But okay, let's see where that goes. Now, again, I know that the panel members are certainly eager to comment on this one. But a number of questions were also now by Chiara addressed also or raised with respect to cost of implementation, duty of the split. So maybe, Laurine, I can do for a first reaction from the panel. How do you look upon the proposals? But perhaps also you could enlighten us whether you think that the proposals are feasible or perhaps create issues in cost or system consequences.
Yeah, thanks, Peter. Of course, and yeah, I'm sure you're familiar with that, but DSM uses a functional P&L, and that's for a reason, because that is industry standard, etc. You can see all the triggers in the exposure draft, so there is already support for that. And I'm also fine to document that choice, because I think that's good, that you should be able to explain why you use a certain splitting cost. I think DSM also provides certain elements of the cost by nature, because there's a need for it to document that and to report that. But then, yeah, it's a bit strange that if you do that, you're still required to now to also disclose your expenses by nature, which is, of course, you can account for anything, and you can also change your systems, etc. But this is not the way that we record and internally report on our expenses. So if that actually would pull through, it would require us to quite some admin and also some IT changes to make sure we have the information. And I think what's also important is that we have not received questions from analysts or investors that want to have more information, because usually there's an intense dialogue also with our stakeholders that would want to have more information. So the fact that the users would like to see it, or this full disclosure, that could be the case, but it's not our experience. So I think we are one of the companies that will have, if this exposure draft would not change, will be significantly impacted. Of course, anything can be overcome, so I don't want to be too dramatic here, but I mean, if there's a need for more information, then we're fine to think about it and to do report on it, of course. But it does pose us for some challenges.
Yeah. Okay. You certainly should not shy away for challenges, but that's a personal comment. But others, perhaps also going to Dennis. Should DSM undertake the challenge? Is it important? How do you look upon that?
Thank you, Peter. Well, I kind of, as Chiara said, that there's a support, perhaps a preference in Europe for reporting by nature. So, having the by function and the additional disclosure by nature would be very welcomed by the investment community. My private view is that we would also be supporting a mixed presentation. So if it is more insightful, then I think it'd be great for companies to say, look, there's part of the information that we provide by function, but we're gonna separately disclose an impairment charge or a restructuring charge. So combining by function and by nature, I think that's going to be useful for investors and analysts.
Okay. Thank you for that. Martijn, no doubt you also have some further thoughts.
Yeah, thank you, Peter. Okay. Well, this is going to be a bit challenging because for investors, comparability is really a very important topic. And you kind of give up on comparability if a company goes reporting by nature. And the proposals as they are now, they accept that this is a problem by requiring the disclosure of by nature in the notes. I really would like to highlight that this is not a full solution for many investors, because all the other notes relate to the primary financial statements based on by function. So you do lose quite a bit of information if you only present the by nature in the notes. So I think the proposals would gain in strength for investors if by nature is mandated, and that a company has the freedom to either mixed or by function or whatever they want, separate in the notes. That would be more beneficial for comparability, for forecasting. The notes would be linked to the by nature function. But I must admit that this will be quite a big change for many corporates. So it's not, I do want to express this desire, but I'm willing to look as well to how can we accommodate the basically more closer to the current situation. And I hear there's a lot of pushback against the mixed model, and I think what the IASB could consider is maybe that a more shielded mixed model could be allowed as well, where it is crystal clear where depreciation is, for example. It should be crystal clear where it is, and as a more mindful alternative, because I think the pushback from preparers is quite big on this, even though I do think that a presentation by nature in the face of the financial statements would add to comparability and analyzability of a company.
Okay. At least that is a very clear view, Martijn. So thank you for that. Filipe, I recognize that there are some questions from the audience, which we will take on board in a minute. But before doing that, I think Ernesto deserves also his view and to express his views on this.
Yeah, Peter, thank you. Where I was pretty positive on the first points that we discussed, here I have more of a concern. Currently, we apply a mixed model presenting by function, and only depreciation is split out, which apparently, hearing Martijn, is welcomed. That is clear where it is. If we are not longer allowed to use that mixed model, that means that we have to allocate the depreciation and to hide it, or we have to go to presentation by nature, which is not the best presentation, especially if you look at other companies. If you look at our peers, they exactly have the same functions categories as we have. And also in the more international perspective, if you look at our US peers, and there are quite some large US oil and gas companies, they have exactly the same presentation. So the proposal doesn't seem to make it better, but worse. In terms of adding that additional note on the presentation by nature in the notes, that will be very, very costly. And the question is, what do we actually achieve with it? I've looked at our general ledger accounts, and if you deep dive there, you see hundreds of accounts, and it's a mixed bag of function and nature. If you would have to change that, you have to go to all the individual accounting entries. You have to rebuild your whole general ledger structure, which will probably be an investment of tens of millions. So it's almost undoable. And then the question again is, what do we achieve by doing that additional disclosure? On specific facts, of course, we can provide additional disclosure, but the whole profit and loss account and all expenses, that will be more than a big challenge.
Okay, thank you for that. And I hear you say the full matrix is certainly not something that you can do from scratch. That's quite. Filipe, I see a number of questions. One deals also with the interaction between B42 and B15, but perhaps you can repeat that, because that's a question that I also came up in our comments. So it is certainly widely shared, but I have some views there.
So the question is, how does the prohibition of mixing methods interact with the requirement of paragraph 42 and paragraph B15? It seems to contradict. Maybe Aida, maybe you would like to clarify the interaction?
Thank you, Filipe. And you've also noted this in your draft comment letter, and I think it's a kind of good question just to make it very clear. And just for everyone, I'm sure you have your exposure draft with you just on the desk, but just in case you don't, I'm just going to mention what this paragraph says. And paragraph B15 is carried over from IS1, and it's about giving examples of when separate presentation of some items could be appropriate or disclosure, and it gives examples of things like restructuring, disposals, impairments, and the like. So things like Dennis mentioned he might like to see separated. What was intended in the exposure draft was this would not be permitted as an item if it breaches the mixed approach. So the only exception to mixed approach is a minimum line items that are in a different paragraph, things like expected credit losses, and the like. So these wouldn't be, so this would mean that write-downs wouldn't be able to be presented separately if a company reports expenses by function. But I just want to acknowledge the feedback we have received on this, some of these items, and I think again, Dennis, you mentioned some of these examples, that actually some of these items can be usefully allocated to functions. Goodwill impairment we hear quite often as specific example. And there are some comments about some others possibly being added to this list of exceptions if the proposal is finalized as a standard, that there is no mixing allowed, so that there might be need to add some more. But maybe I want to invite comments from anyone else on this particular point, if you have anything to add.
I see Chiara making some movements, but I don't think that was asking the floor. But okay, so if I don't think any further comments on that one, Filipe, there is another question related to the more guidance on the allocation to functions, if I understand it correct. Perhaps that's something also the preparers could help us on, but you can best phrase the question.
So the question that was made here, I'm just looking again for the question, but the question made was the need for more guidance on the by function allocation of operating expenses, as it requires some judgment. And for example, the allocation of impairment of assets, whether these type of allocations involve a bit of judgment. So whether there is more guidance, as I just mentioned, on some of items, which some of them are also referred in B15.
Yeah. Laurine or Ernesto, are you short of guidance, or can you draw your own conclusions? How do you? What would be appropriate?
Peter, on things like impairments, we group that together with depreciation and amortization. So that's less of an issue because we don't report that as a function, but by nature. In general, what we see is that we get a lot of questions from the business where to allocate, in what category to allocate, and we report by function certain costs and certain expenses. And every time I go back to people saying, well, there is very, very limited guidance from the IASB. So that may be helpful as long as it's principle based. That may be helpful to obtain consistency.
Yeah, I think in practice, this is not a huge problem within the company. I mean, this has been the way we've been reporting, and we have, of course, our own definitions. But I think that even if there will always be an element of judgment, even if you report something by nature, I think. But I think we're not short of guidance. You could be more strict, but we have not perceived this as a particular problem. So, I'm not sure if that answers the question, but that's even with amortization, depreciation, and impairment, it's also not a big problem. Even allocating to functions, that is also possible. But yes, it requires judgment. That is true.
Okay. Thank you for that. But also, if it is not a problem, that is good also to have that observation at least. Filipe, any further urgent questions as far as you're concerned?
At this stage, I think, for example, when entities present, for example, by function, whether there are some line items which by nature are really important, for example, depreciation and amortization, and allow mixed models for these type of line items. This is one question, but I think we have addressed a lot of the questions.
Yeah, and I think the last one also was already more or less in Ernesto's comments where he says Shell is doing that. So if that's the case, then I return to my habit of asking the IASB if they have some final reflections on this topic that we discussed before doing the same with Chiara.
Hi, it's Nick here. So I think what we've heard very clearly from preparers is that there would be considerable expense in requiring a by nature assessment of operating expenses in all circumstances. I think equally there is frustration from users around the mixed model. I remember being very frustrated. I look at some by function reporters. Some of them have depreciation and cost of goods sold, others don't. I can't really compare those two entities on that basis. There is, particularly in Europe, a strong demand we hear for by nature information. So I think we have to think about how to balance that going forward. I think it's very hard actually to give more direction on the by function allocation. I think there is simply judgment is required there. I think it'd be impossible for us to provide that. I was interested about the last question about, yes, there are clearly some by nature expenses required, say, in all circumstances. So employee costs, depreciation, amortization. The other thing we often hear from users is raw material costs, where there isn't always full disclosure around that. And there's been, we've had some discussion. Would a way forward be to attribute some of those required costs to the various functional lines, which would then sort of give a bit of tie-up by function presentation with elements of by nature costs rather than the full matrix. It's clearly something the board will have to spend some time thinking about.
Okay. One of the comments in our comment letter will be exactly also to think about that, whether that can solve some of the issues. But you're already coming on to that track then yourself, which is good. Chiara, some further comments from your side?
I think a lot has been already said. From the preparer's perspective, of course, the impact, it depends from the starting point. So this will leave for sure more investments for some and less investments for others if the requirement stays as it is. It was also interesting to hear Martijn asking to keep an eye on the comparability, because at the end of the day we are leaving another option to choose, either by function or by nature on the phase, and this is a sort of another option, option. So I think we not always we had this element of the comparability in this debate. It was more about the users wanting the by nature and the preparers being in a different position compared to where they are now. So I think it has been insightful to have also this nuance in the discussion.
Okay. Thank you for that. Thank you all for this good exchange again of considerations and views. And then maybe that is also the good point to turn to topic 4. And topic 4 deals with management performance measures and also unusual items and the information on those. And certainly management performance measures have been, let's say, in the forefront of the attention also of the regulators. So it is good that the IASB takes up that subject. And yeah, what are the proposals there? I think, Aida, you wanted to also discuss or present those, but I may be wrong.
It's a dynamic world that we live in. So I'm going to start off on management performance measures and then pass over to Aida on unusual items.
Okay.
So as I mentioned at the start earlier, that what we hear very clearly from investors is that key non-GAAP measures of performance are useful to their analysis, but they sometimes lack transparency. And furthermore, the information about those measures is often scattered through financial reporting. So sometimes it may be in the financial statements, sometimes in the management commentary, sometimes in the press release, sometimes in the analyst statement. My experience as a global investor is that you never quite knew where to look for this information. And indeed, you mentioned regulators. ESMA undertook a survey of alternative performance measures back in 2019 and identified a number of shortcomings in relation to explanations, reconciliations, and definitions of non-GAAP measures. So the next slide, slide 27, talks about the board's response. And so the board has defined management performance measures as subtotals of income expenses that complement press totals or subtotals and are disclosed in public communications outside the financial statements. Clearly, it's important that those measures communicate management's view of an entity's financial performance. And the proposals, in some respects, do build on the ESMA 2015 guidelines for APMs, and so requiring a reconciliation between the management performance measure and the most directly comparable IFRS total or subtotal. And if we go right back to the start, and that proposal about having more structure in the statement of financial performance, clearly there's then more anchor points to reconcile back to. A description of why the MPM communicates management's view of performance, including how it's been calculated. And importantly, because investors do like to see consistency in these measures, an explanation any changes have been made in how that measure has been calculated from one period to another. So as I mentioned, the proposal is that all of these information, all of this disclosure is included in a single note to the financial statement, so investors know where to find it on a consistent basis. And those measures would also be subject to assurance, and clearly in the jurisdictions that fall outside of regulatory oversight, such as that of ESMA and other European regulators, it would help bring those measures into some kind of more transparent framework. So what are actually MPMs in terms of financial measures? And that's clarify that on the next slide. So as I said, these are financial performance measures. So it excludes things like number of subscribers, customer satisfaction. They are required to be subtotals of income and expenses. And so that would knock out measures such as free cash flow and return on capital employed, net debt. Very happy to discuss those. We've had some strong views on those. And clearly it doesn't apply to IFRS specified measures such as operating profit, profit and loss, or operating profit before depreciation and amortization. But it would apply to something like adjusted profit or adjusted operating profit. So just finally here, a word about EBITDA, which has already been raised earlier in our conversation. So the board recognizes that EBITDA is used frequently within capital markets. It's thought about defining EBITDA, but the problem the board came up with, if you literally take the acronym EBITDA and use that, so if those letters faithfully represent what it purports to be, you actually end up within that definition with associates, the share of profit and loss from equity accounted associates and joint ventures within that definition of EBITDA. And given all we heard about operating profit, the board was uncomfortable with that outcome. So in response, the board decided to define a new measure called operating profit before depreciation and amortization, which clearly wouldn't have any contribution from equity accounted investments. And if you use that as a measure, that wouldn't be NPM. You wouldn't have to reconcile to it. But if you used anything different away from that, a different type of EBITDA, you'd be required to reconcile to that measure. And the following slide just briefly looks at perhaps a potential example of what a reconciliation in the notes might look like. And we see, again, these proposals are often just on the next slide, the reconciliation slide, slide 30. And here, reconciling to the nearest comparable IFRS specified total or subtotal. And in addition, requiring for each adjusting item the tax and effect on non-controlling interests. We see this for some entities already today, but clearly not for all entities. And partly this goes back to the analysis that I found, particularly on the buy side, investors like to do of management performance measures. They want to understand how these impact at the earnings per share level, and they also want to decide which of the adjustments that management make they wish to accept themselves and which they would rather not have adjusted in the adjusted measure. And providing them with the tax and NCI information allows them to do that. Effectively, I think any entity today that produces an adjusted EPS number must have actually done those tax and NCI calculations anyway to come up with that measure. So that summarizes our proposals around MPMs. And just before we pass back, let me hand over to Ida to talk about unusual income and expenses on the following slide.
Thank you, Nick. So we have one slide on unusual income and expenses, and situation with this is a bit like with MPMs. It's information companies provide today and users find useful for forecasting, but the users have problems with what is provided to them in that there is a huge variation in how items are defined, and it's often not clear to users how and why items have been identified as, unusual, non-recurring, or any of those labels that are used today. So with that in mind, the proposal is to require all companies to provide this disclosure of unusual income and expenses. And we have a proposed definition here on the slide. You can see, and the definition very much is forward-looking, so it focuses on expectation of recurrence of particular type of income and expense, and says if something that's similar in either type or amount is not expected to recur, then this item would be classified as unusual income and expense. And then there is a number of disclosure requirements, but to note, this would be disclosure in a note to financial statements where all information about unusual could be provided, because users tell us they are not only interested in amount, they want explanation around what has given rise to this, which would be in the disclosures. But to be able to allow users to link unusual items to what is presented on the face, companies would also be required to show to what item on the face, or in which items on the face were particular unusual items included, and also provide this information of linkages to analysis by nature if company provides analysis of expenses by function on the face. I mean, one important benefit of this proposal is completeness, and one of the criticism of unusual today is that it can be selective. Companies may focus on unusual expenses, but not necessarily identify unusual income until maybe in future when that income does not recur. So this no disclosure is aimed to achieve the completeness of the analysis of unusual that wouldn't depend on what company has chosen or not chosen to adjust for in their management performance measure, and hence it is a separate proposal, although it is linked. And I think in practice the expectation is that companies that do use management performance measure would tend to adjust for items identified as unusual, as well as maybe make some other adjustments for items that are not identified as unusual. And we think this might be the case because the proposed definition is quite narrow, and we had some significant feedback on that. But again, I will let Chiara share that feedback on management performance measure as well as unusual income and expenses.
Yeah.
Yes, I was unmuting, sorry. Yes, thank you, Aita. This proposal was one of the most debated at the times where we issued our draft. We are suggesting the IASB to broaden the scope of the definition to include also other items than simply the subtotal of the profit or loss, but to consider also other elements such as indicators of financial position or ratios. Because this was also was confirmed also from the field test, where preparers felt that limiting these concepts to the P&L would provide a partial depiction of the management of the entity's performance. But what triggered the discussion, I think, was the proposal to include the reconciliation, the definition in the financial statement for the MPMs that are used in the communication, in the public communication. This is because we describe in our comment letter a list of concerns of those that do not agree with including all the indicators that are in the public communications in the financial statement. For example, they said that the quality of the data is not comparable to date, and it would not be easy or it will be costly to audit this information, or are concerned about the undue prominence of these new gap concepts that would result from the proposal. And this was one side, but from the other side, there were those that considered this move from the IASB is decisive to remediate the current situation of lack of comparability of transparency in the use of the management performance measures today. So that's why we didn't take a position yet. We are really keen to understand where the constituents in Europe are. We are proposing two possible scopes for this proposal. The first is whether the MPMs should be limited only to those that the entity chooses to disclose in the financial statements and in the management commentary. And a broader scope is to include the reconciliations and the definitions in the notes to the financial statements for all the indicators that the entity uses in the external communications that are released jointly with the annual interim report. So we are very keen in understanding where the constituents are before taking a decisive position on that respect. Well, we are also asking feedback for costs and benefit of the split of the tax effect and the NCI effect. This from the field test was one of the challenging areas, in particular for complex groups that operate in different jurisdictions and are subject to different taxations. And then, of course, there was another question to what extent these proposals could lead to an increased or decreased number of MPMs. We understand from the preparers in the field test that for sure the new definitions and the new categories may trigger an impact on the current measurement used from the management, but this is pretty obvious. But I don't think we have heard anything decisive on the number, whether it is increasing or not. Do we have another slide on this topic? I think so. Yes. Very good. No, because one of the points to consider, at least from a European perspective, is that the users and preparers have done already an investment in getting familiar with the requirements from ESMA, where the definition to be applied is alternative performance measures, and it's broader than the MPMs because it is not limited to the P&L, but it is different in scope because it applies to the disclosure to the indicators when they are disclosed outside the financial statements mainly. So the scope of application is different, and for sure the opportunity to include this reconciliation in the financial statements would add something that today is not done by the ESMA reconciliations, because the ESMA reconciliations are not in the notes and are not, for example, subject to audit. However, it was observed that there is a certain level of overlap between the two definitions and interactions between the two. So the users will have to get familiar with what is an APM and what is an MPM and what type of difference, if any, in the definition and quality of data do exist between the two. But I would say that this is pretty understandable for a change of this magnitude. Can we go to the next slide? Yes, unusual income and expenses. We welcome this proposal. We think that it will help to get more transparency in the information. What we know from studies on the current use of MPM is that when entities, and this happens very often, present a recurring or underlying profit, they tend to exclude cherry picking of items, and often they result in a more rosy picture. So having altogether all these elements of unusual income and expenses with a balanced approach, we think will provide a step forward in the transparency. However, we discussed what does the definition will imply in practice, and we commented that the current definition seems to be a bit too narrow, because it would exclude examples such as the restructuring costs when the process of restructuring may last for some periods in the future. So we know already that it is going to recur in a certain number of years, but it's clearly something that do not belong to the underlying quality of earnings of that entity. So in that case, we suggest the IASB to refine the definition. We also know that in some European jurisdictions, the term usual may sound a bit strange when it comes to accounting terms. So we suggest to have also looked to this element. And we also ask to clarify whether an entity would be allowed to flag as a label as unusual some items presented on the face of the income statement. We also noted during our debate that this is not going to have back the presentation of extraordinary items, which was forbidden already a while ago. So someone was wondering what is the difference between extraordinary and unusual. So there was an element of debate in that respect. I think this is all.
Okay, thank you very much, Chiara. And I have to admit that was quite comprehensive. So I will also limit myself a bit on the Dutch Accounting Standards Board's views to allow for some further discussion in the panel. Although some highlights, we do support, of course, the use of management performance measures. And similar to EFRAG, we're also a bit concerned that the current definition chosen by the IASB is too narrow, and that it should be wider than just subtotals of income and expense to be covered by those. And we also think that it might be worthwhile to think along the two lines. What would be the requirements for management performance measures that are used in the financial statements? They should probably be addressed in a IASB standard. And maybe those used in the management comment should also be discussed in the practice statement or management comment. That would allow also in different jurisdictions regulators to say we pick both, or we only choose, for instance, the financial statement ones, because that is regulated and there we have to apply IFRS. But I will not go into much detail now. We have that in our comment letter. On unusual income and expenses, again, I share the observations that were made by Chiara. I think one of our views also is that we have currently in IAS 1 the requirement to also explain material items of income and expense in paragraph 97. And although unusual looks a bit like a similar concept, we still think that it may capture different things because it takes a different lens. In unusual, you look at what's expected to recur. In the current IAS 1 disclosures, you simply look at material items that are interesting to know. So we still think that the IASB may want to consider how these two mesh together or whether there is a conflict there. But after those few observations, and knowing that we have about 15 minutes for the final discussions in the panel, I would like to ask the panel for views. And I know that I've been always trying to be careful to have somebody introduce the subject, and I seem to recall that Dennis hasn't had that opportunity so far. So Dennis, perhaps your views first.
Clearly, we are supportive of the use of management performance measures. We are supportive of the provided reconciliation to an IFRS subtotal. I'm less convinced the IASB needs to say something about non-IFRS metrics like returns or net debt or like-for-like sales, which cannot be easily reconciled to IFRS subtotal. So I don't see a role necessarily. So I would agree with the scoping of the ED. In terms of unusual items, we believe that either they're defined too narrow, but you can also ask the question, why don't we expand the discussion on disaggregation and provide more granularity and more disaggregation within the financial statements, which would make defining unusual items somewhat superfluous, because you don't need the definition of what is unusual if there is more disaggregation. So if the IASB would continue on the definition of defining unusual items, I agree it should be broader. If we say, is it really necessary, then that would be our preferred route. We don't believe it's really necessary if there is more disaggregation, and then analysts and investors, users, can make up their own mind whether they believe that something is recurring, non-recurring, predictable or volatile, or whichever other dimension they want to use to assess income and expense items. Thank you.
Okay. Thank you for that. Martijn, would you follow up on that?
Yes, thank you, Peter. I generally concur with Dennis.
Your smile suggests that you do. Yeah.
I would like to highlight that investors do not only rely on the financial statements. They also rely on investor presentations and other media targeted at investors. And I feel shielded by the requirement to include measures that are communicated to investors, financial measures that are communicated outside the financial statements, will at one point in time be included in the financial statement as a note and be audited. Because investors, they trade, they put a price, they judge on investor relation presentations and the like. So I think this is an important one. However, I'm wary of potential unintended consequences. It should not be that if a company happens to also report in US GAAP, that all those numbers need to be reconciled either. It should be really clear that we're not targeting regulatory filings of companies. That should be, and I think potentially it would require a fourth criteria that says that mandatory frameworks that require certain disclosures are excluded from the MPMs, because other mandatory frameworks than IFRS can be required. So maybe because nobody is waiting for a balloon of the notes on MPMs. Okay. Then on unusual and the definition thereof. Somehow cost, exceptional cost or unusual cost, companies find it easier to identify those than exceptional incomes. And maybe the standard can somehow be worded in a way there's some sort of reciprocity, like
reciprocity works.
That if management somehow judges a certain item to be unusual and it's an expense, it should also be applied to similar deliberations about certain incomes. I think that would probably add, because we don't worry as investors that companies will not use this properly for expenses. The worry is that we don't know the unusual incomes and cannot put our own judgment on those. So that's an element that I would like to highlight as well. Thank you, Peter.
Okay, you're welcome. I think that is very clear. And indeed, that symmetry between profit or income and cost, I think that is one of the contentious issues that certainly needs to be addressed. Okay, going to Ernesto first, and then Laurine to finish this round. Suggest Ernesto.
Yeah, thank you, Peter. Yeah, of course, we support that transparency should be out there on MPMs and also on APMs. Where we struggle a little bit is that we have already this ESMA guidance and that we already have guidance from the US, and we're a foreign filer in the US, which means that we make all these reconciliations already in the annual reports. Now, it may be scattered across the reports because only the ones that are P&L ones, the MPMs, are going to be in the notes in the financial statements, and all the others are in a different place in the annual reports. So maybe a waiver if you already comply in the annual reports with the requirements to put that notes would be helpful. Otherwise, people have to look everywhere for it. So that's a little bit of a concern in terms of the content, making it more transparent. That's not an issue at all, of course. On unusual items, yeah, I struggle a little bit. If you look at the definition, it says not to arise in several future reporting periods. And then we look at some items that could classify as unusual. For example, impairments. Well, if I look at impairments, if I look over the last few years, we had impairments almost every year. So, well, it's not unusual. Disposals. We have disposals all of the time. Same for inventory write-downs. Restructuring seems to go every year. So what's left? I struggle a little bit with that. So we have no unusual items other than some immaterial items maybe. So this concept is difficult. We apply something called identified items where we clearly put a definition on, which counts symmetrically for income and also for expense. And it's a little bit wider than that. But I'm not sure whether this unusual item, the way it's phrased now, will give any additional insights in our reporting.
Okay, thank you for that, Ernesto. Laurine, any further thoughts from your part? No doubt.
Yeah, of course, I have many thoughts. I will keep it limited, Peter. I think with the introduction of ESMA in 2015, we also had an extensive evaluation of how to present adjusted management performance measures. So actually the proposal from the IASB was not a surprise. And also we already, I think, implemented a couple of these, like putting everything in one note and have a reconciliation to management performance measures inside your financial statements. So it would also be subject to the audit. And that was a clear preference. So the change is not huge. It's true that it's just items of income and expense. But of course, that's also a driver of many other management performance measures. So I don't see a big problem in it. Also, you can also disclose more if you want to, which we also do. So we have some more disclosures on how we calculate some balance sheet related performance measures. So I don't see a problem in the standard being implemented as it is now. What Ernesto said about the concept of unusual, there I have a concern, because on the one hand you can say it's too limited. I don't have a problem with the items we currently identify as adjustments. We can easily fit into unusual, albeit there be a discussion maybe on restructuring costs or costs that are recurring but unusual. So yeah, I'm not sure how to interpret that. And then also the concern of not identifying unusual income as unusual. I think that also, yeah, maybe it should be more clear in the standard that it's both. I can say that as your responsibility to report outside, we have a clear process that identifies both. So it's not at will, and if you have a clear policy, then it helps to be complete on that. That's so to say.
Okay. Thank you for that. And I'm also recognizing the time. So I think those were insightful comments, but certainly also we have the opportunity to invite views from the audience. And I would ask the Secretariat that we do polling question number 6 that deals with also the unusual items, to see how the audience thinks about those items and whether they think they should be disclosed separately or not. So the question is question 6 in Slido. Should unusual items be disclosed in a separate note as proposed by the IASB? And we have 2 options for yes, 1 option for no, and 1 option for those who do not know. And I can't comment right now because I have to flip something away, which does at least support the view of the IASB at this moment in time that those items should be disclosed in a separate note. That's at least 50%. And if some further votes come, it takes down the support slightly, but and then that's surprising if you keep noticing the way that voting develops, because we're now getting more or less to a split yes and no votes. So really everybody who is filling in his vote now is really having an impact. But it's, let me say for the time being, it's more or less split between those who say they should be included or no, it's sufficiently regulated in existing IFRS. But bottom line, the yeses are winning because also the full support is still with 21%. So on balance, I think there is support for the proposals, either as they are proposed by the IASB or with a slightly wider scope. Okay, that's having said that, and noticing also the comment that we are 5 minutes before we close, I suggest that we leave this interesting part of the debate where we currently stand, but I do give the last opportunity to Nick or Aida to say a few words on how they view the debate so far, and to Chiara, and then we start to close it off.
So just, I think, thank you to everyone for all of the comments today and feedback. It's been very helpful. There's lots of information for us to take away and think about. NPMs that we've just discussed is an area where we get strong feedback from the users of financial statements that this is moving in the right direction, and indeed some calls for us to go further, particularly free cash flow measures get called out. Maybe something for a future project on cash flows. Just to remind everyone, the board's next agenda consultation will be kicking off next year, and that'll be very much an opportunity to flag that. But as I say, this has been a very helpful event, and we'll take away and gather all that feedback together. I see we did have one question earlier about when will the standard come into action, and perhaps it's a good time to address that. And I think all I would say is that anything I would say would be a guess today. And we really need to wait until we're expecting a large number of comment letters on the proposals. We need to wait till we've seen those and analyze those. We've also undertaken extensive outreach, including many events like this. We know that some issues are contentious, others there's more clear support for, and clearly the board will need to work out which topics it may want to redeliberate. And I think it's important that we do this in a considered fashion rather than necessarily in a hasty fashion. Lots of important things here. We know users have been looking for this for a long time. And as I say, thank you very much again for all we've heard today.
Okay. Thank you for that, Nick. Chiara, any observations from your part?
Well, I think on NPM and usual and unusual, a lot has been said. we will see how our this final discussion will go in terms of positioning of this disclosure and in terms of the two possible alternatives of scope. So the feedback is highly welcome in that respect, where we have an open position. And in general, I'm very pleased about the event today, and I want again, because I understand that in 1 minute then it's the turn of Gerard to conclude. I wish really to thank the participants, you, Peter, and the Dutch Accounting Standard Board, the panelists, and the ASB and EFRAG staff for making all this possible.
Okay. Thank you for that, Chiara. Yeah, and then we turn to the person who has been silent so far. I noticed that he's still in the meeting. I'm happy about that. Gerard, we had asked you to prepare a kind of takeaway for what you heard today and what you heard us discuss. I give you the floor for that. As we also agreed, I will then finally thank everybody again on behalf of the Dutch Accounting Standards Board. But before that, the floor is yours.
Thank you, Peter. I've definitely been actively listening and not doing something else for sure. It's been a very interesting debate, and what we started with was kind of the objective was breaking the boilerplate. However, you could see that as contradicting what this project is actually about, because the key is also to get consistency between the different reporters, what is very relevant for users. But personally, I don't think there's so much a consistency, because this is really the relevant information where the users clearly indicate that having consistent information is key. I was also very pleased to see that more than 50% of the participants are actually preparers and that they are very interested in this topic, because ultimately this is a lot about communication of investor relations between the preparers and the users. You could say that these proposals are not very technical, so some diehard IFRS people may not like that, but they're very simple concepts, but they are very relevant and have really a huge impact. And I think sometimes we overlook that a little bit, and maybe we think about that getting the numbers right is really about the nitty-gritty, but I think some of these proposals are really key in getting the right information. And if you look at the several topics, effectively it's around one end consistency, but also the management view and what choices do we make there, and transparency, especially if we cannot make a choice, then transparency is really, so those are the three main items. If we then run through the topics, and the first topic was the classification of income and expense, and especially defining and disclosing an operating profit number, my first thought was that the polling had been rigged or had been hacked, because there was such a huge majority of that this should really be included. And I think from some of the panelists, it was even said, yeah, why didn't we do this before? And it's low-hanging fruit. So I think everyone is very positive. Of course, it still needs to be seen how it will work out in practice, because I think previously the practical implementation still seemed difficult, but I think with some of those clear definitions that we currently have, it will be very great. I think one of the other key takeaway is that if we have that distinction in P&L, it would make a lot of sense to have a similar distinction in the balance sheet and the cash flow statement as well. I think it's good from the IASB to just do first the P&L, because if you want to change everything at the same time, that's generally difficult. But if we get into this classification, I think the logic next step would be to see what does this mean for the cash flow statement and what does this mean for the balance sheet, because ultimately they are derived from the same type of activities. If we look at the second topic, integral versus non-integral, there it was really a glass half full and half empty. And let's start with the half full. I think everyone kind of agrees to have an operating profit measure before the results of investments in associates and joint ventures is very helpful, improves consistency, and also from the valuation perspective. However, we also were clearly noted that associates, especially also joint ventures, and I think Ernesto explained it very well, really have are really a key part of the operations of an entity and are different from just doing an additional investment. And maybe that has even been highlighted by the implementation of IFRS 11 a few years ago, with a very significant distinction whether something qualifies as a joint operation or as a joint venture, while from a business perspective, the difference may be much less. So I think there's still clearly a request that can be appropriately being presented, and maybe the integral, non-integral as currently defined doesn't entirely solve that. And alternatively, of course, we have MPMs, but that including the results from investments in joint venture associates already as an additional measure of operating profit still seems to make quite a bit of sense as long as being done sufficiently transparent. If we then went to topic number 3, analysis by function and nature, I like the sentence of Martijn: where's the depreciation, where are the employee expenses, and maybe also where are the raw materials in the P&L. So if those are really the key topics to look for and being transparent about that, then maybe also those items should get sufficient highlight, and then whether that's being done in a functional or in a by nature, probably both can serve their purpose. When we're talking about this topic, from a personal note, I'm always thinking back to 2005 when we transitioned to Dutch GAAP to IFRS, and how relieved we were that we no longer had to use the required models as prescribed in Dutch law based on the European directive, and had more flexibility between function and nature and any mix thereof. So it will be seen if we really move back, well, how that feels, and maybe that's simply a long time ago and the world is a little bit different now. Finally, we discussed there the full matrix. I think for some people that remembered the movie The Matrix and still sounded like science fiction. So I think although it may work in theory, I think the message was quite clear that it's really, from a practical point of view, really a step too far at this moment. Then topic 4, the MPMs and unusual items. Again, I liked the comment from Martijn. MPMs are not bad. I speak to users, but I also speak to financial journalists regularly, and they really dislike MPMs because they always think that's the way how management is cooking their books, so to say. But that they do have value and are of interest to users and analysts, I think is very positive. But it's also very clear that there need to be sufficient safeguards, and that's coming back to symmetry, also unusual items, not just say excluding the negatives, but be fair and balanced in that perspective. We also discussed EBITDA versus OPBDA. So I think if we're just looking at the acronym, it doesn't beat EBITDA yet. So if we really want to focus on operating profit before depreciation and amortization, then maybe someone should come up with a smart acronym. But I think there the IASB, and I think it's clear to everyone to strike a balance there between the already used measure versus a new one, operating profit before depreciation and amortization. And I think we'll need to see in practice whether one will replace the other and it will become more consistent in that perspective. Finally, we discussed unusual, and I think there was, at least in my perspective, a quite common theme that the current definition seems to be too narrow if this would be the only disclosure of these type of items. So either it should be in addition to material items or identified items, as Ernesto mentioned them, but it seems like it's very limited in scope and therefore possibly would not fully fit its purpose. Having a focus on symmetry I think is really key there. Then some other final words. One of the questions was, when will this standard being implemented? Well, I think it's a fair bet from my side that this will at least take another 2 years. And at least in a European environment, by the time we will have hopefully implemented ASEF, the European Single Electronic Format. And you could read some of these proposals that we are still in an analog world or a paper world where we really need to choose one or the other. And I really hope that through further digitalization, it becomes easier to fulfill both the management view as well as the kind of consistent view that, for example, in valuation models is applied. Again, I don't think we should wait with this standard to see how it exactly interacts with kind of these developments. This is a key step to take, but I do believe that probably once this standard is final, it will be very soon thereafter that we need to rethink again about using digital tools and how could that make a further step. So overall, a very interesting debate with all of the participants, and I think, yeah, a lot to look out for, and definitely an improvement in financial reporting going forward, and in my point of view.
Okay. Well, Chiara, thank you very much for that excellent summary and takeaway. I think you captured what we discussed very well, and even took some of your own views into that, which is appreciated. So thank you for that. Thank you for listening carefully. I would also like to express my great thanks to the members of the panel, Laurine, Ernesto, Martijn, and Dennis. You helped us a lot in bringing your views into the debate, in sharing your views with us. Thank you for making the time available, but even more, thank you for your consideration and thought process on the various subjects that we discussed. Chiara, and also the whole team at EFRAG, you were tremendous, not only in supporting the due process for European stakeholders, but also in helping us organize this event. So much appreciated, and again, good luck also in collecting the final comments from European constituents for your own input into the IASB due process. Yeah, that brings me then to Aida and Nick, who were instrumental not only in helping us understand the exposure draft, but also in creating and developing it together with their colleagues at the IASB. I think it is a major step forward, certainly in financial communication, and we will be watching carefully how you are going to take it to the next step and when you're able to do that. And we will certainly share our comments with both EFRAG and with yourself to help you further improve on the exposure draft and to bring that to the final standard. But it is a worthwhile piece of work, and it is certainly worth all our time to think carefully about that and to hopefully further improve communication with investors and stakeholders in companies. For the audience, finally, thank you for being present. Thank you for remaining present. I see that most of you have stayed on board until the end. Also, your input, your questions are highly appreciated. And don't forget, the exposure draft is still out there until the end of the month. You can provide your own input and your comments. And as this is an important subject to all, I recommend that you try to do that for the areas that you find interesting and important to reflect. Having said all that, sorry that we can't meet in person, but thank you all for your time and your participation. Have a nice afternoon.
Thank you.
Don't know.